Good morning. It is 10 a.m. on Friday, the 27th of August. We're almost into September now, but we're back again with another episode of Southbank Live. I'm joined, as ever, by John Butler to discuss some of the interesting investment trends and themes that we've seen over the past week. John, thank you so much for joining me.
My pleasure as always, Boaz.
Now, as is the norm now with Southbank Live, it is a live chat. So if you are interested in asking us a question or just leaving any feedback, do feel free to leave that in the chat. If you're watching a recording of this, please do leave any feedback in the comments below this video. And of course, if you do enjoy these, please do subscribe. Now, coming on to our main theme of the day, John, was this very, very interesting statistic that I recently came across, originally from a market intelligence firm called the Marketeer, and it was really quite extraordinary. And it made a lot of sense to me, some of the, when you think of some of the action we've seen over the past year. And it's all about the huge amount of money that has flowed into equities this year. So, judging by the average $115 million going into global stocks every trading day over the past 25 years, that is that average over the past quarter century. But this year, things have been way, way, way more extreme, where you're looking at $3.98 billion going into stocks every day. And that's 34 times the average over the past 25 years. Where is all this money coming from? Because it does seem like an awfully lot, an awfully large sum of money to be going into the stock market every single day. Where do you think this is? What do you think is causing this? And who is it that's got all of this money that they can just buy a few $1 billion worth of stocks every trading day?
Well, of course, ultimately, money is going to originate from the central bank. However, in practice, the way money, in fact, is originated is through bank lending, which is then done against the available volume of reserves in the system that have either been previously created by the central bank or are subsequently created by the central bank in response to allow that commercial bank money creation to take place. So there's a slight chicken and egg aspect to it, but ultimately that's where the money originates. And that money then, of course, to the extent it's not simply being spent in physical form as it moves around the real economy, it needs to find a home. And if the home isn't a bank deposit, well, then it's going to be a security of some kind, right? It's going to be a stock or a bond. And that is what we've seen here. You've simply seen, and we know this, right? We've simply seen a huge amount of money creation over the past couple of years. Although that said, it's part of a longer term trend, and that is monetary inflation. And that excess money, if you want to call it excess, because it's not being used in spendable form day to day, that needs to find a home. And over the past year, as you've pointed out, the home that the holders of that money have found disproportionately desirable has been the stock market. And so, yes, you have these outsized numbers as a result not only of this wall of cash, or call it whatever you want, but also a clear preference to allocate disproportionately more to equities than to bonds.
Right. And so, there is so much money in the bond market in general, and generally you would have seen an awful lot of money going into bonds, into debt, because people want to earn some interest on it. Would you associate a huge amount of the skew towards stocks these days simply because the bonds aren't yielding anything?
Well, of course, that's a huge part of it. I mean, who wants to earn zero? Now that said, certain entities have to purchase a certain proportion of bonds
Yep.
and hold those in their portfolios, regardless of valuations. First of all, there are the central banks themselves who purchase government debt as the asset against the liability of the newly issued currency. Then there are the commercial banks, that is the commercial banking system. To the extent they're not lending out their reserves, they've got to park them somewhere, and they can park them in government bonds if they choose to do so. Then you've got regulated insurance companies and pension
Yep.
funds, which are in essentially all jurisdictions required to match their asset maturity and duration profile to their liability maturity and duration profile. And that effectively forces them to buy a certain portion of bonds in order to do that regulated asset liability matching. And so a significant portion of the bond market, will be taken down. The new issuance will be taken up by these entities. But that still leaves a lot that is discretionary. And that's where your argument is absolutely correct. Why on earth would a fully discretionary investor with no constraints choose to park their money in zero yielding bonds, especially now that inflation has clearly been on a rising trend and is now, depending on which index, which measure you're looking at, is the highest it's been in decades. And so the relative attractiveness of equities becomes somewhat more obvious in that context. And look at yields, right? Equities also offer yields if they pay dividends. The yield on the US S&P index, although it has declined substantially over the past year or so, it's still about 1.3, 1.4%. And that's a hell of a lot better than
Yeah.
zero. And of course, longer dated treasuries do yield something. I believe it's in the range of 1.25 at present. So the two are kind of comparable. But whereas bonds, by definition, lose their value in an inflationary environment, the same is not necessarily true of equities, because equities represent claims on future corporate profits. Those tend to rise with inflation. And so equities are less likely to see their values eroded by inflation. So if you can earn a dividend yield above the level of the bond yield and participate to some extent in the rising prices alongside rising inflation, that's better than parking in bonds. So I think that's the single best explanation for why we're seeing this.
Yeah, but 35, 34 times more than the average is still really quite extreme, because interest rates have been falling for a very long time now, and this year is no different. We have seen some pretty extraordinary moves downwards in interest rates all over the place, which will create all manner of problems in the future. But we've not seen such a collapse in interest rates that would merit 34 times more money going into equities, don't you think? Do you think there's maybe some other angle, some other spin here?
Well, there might also be a base effect. Remember that COVID scared people at first, and you did see a sharp sell-off in equity markets in early 2020 as a result, right?
Yep.
Things came off pretty hard. And while the US market has clawed back all of those losses and more, and has been hovering around all-time highs in recent months, the same cannot be said for all markets, including the FTSE, for example, which
Yep.
came off hard and yet has yet to regain those pre-COVID highs. So it could be that some of this 34 times figure is a bit of a base effect on what was a weak period recently. As you say, though, it's vis-a-vis 25 years of data, but keep in mind 25 years ago, because there was far less money swirling around in the first place, by definition, your average over those years is dragged down because we've been on an uptrend of increasing money generally, chasing assets generally.
Yeah. Yeah, it would be good if the FTSE could capture some of this $4 billion a day. I'm sure there are plenty of British investors who feel that we're missing out. I mean, and it's the same can be said, I think, for all manner of different national stock markets out there. Why is the US attracting so much capital at the moment? What is making it burn so hot? Before we go quite to the valuation side, because of course this trend is causing a huge amount of just really, really fantastical valuations when you think of how much time is going to need to elapse before people, get their money's worth back in dividends and things like that. Before we quite get there, we did run a little poll on our social media channels just to see what our readers were thinking of this trend. Where is the money coming from for this $4 billion a day? Above the normal average of $115 million a day. Why are people buying so many stocks? And so there's an interesting trend with the millennial generation, which has only recently entered what should be the millennial generation's prime earning years. Of course, job prospects are not looking great for millennials at the moment. They are still entering what should be their the golden years for earning the big bucks. And so maybe the millennials are really into getting into stocks, or could it just be people buying stocks in boredom? We did see all the lockdown moons for in Robinhood shares, the shares like Hertz and things like that. And then, of course, passive fund whales as well. So passive investing has taken off so much over the past just the past 10 years, really. Is this what's moving the market? Is the passive funds which just buy stocks, just buy an index like the FTSE or the S&P, though definitely the S&P in this scenario? Is it just these fund whales that are pushing so much money into stocks because people are just automatically buying them with their pension contributions and things like that? And so I think it was on Facebook that we got, we were looking at it was the millennial angle that people were thinking of, whereas on Twitter people think it was more stocks being bought in the lockdown boredom. But John, I mean, when you're looking at somewhat more downstream of the central bank, so you're looking at the decisions being made by investors, how important do you think the millennials investing is having an impact on this dynamic, or the lockdown speculative frenzy we saw, or the rise of passive? What would you say is the biggest driver of this big flow into stocks?
Well, again, I mean, leaving aside what we've already discussed, which is just that there is so much money sloshing around out there that needs to find a home,
Yeah.
and the home appears to be, the preferred home is equities because bonds yield essentially nothing. Well, once you remove those factors and look, what else is it? Certainly, passive investing is huge, right? I mean, that's been a trend for decades now, and it's unbelievable if all you want to do is hold major market indices through a major ETF provider. I mean, it costs you almost nothing,
Yeah.
right? Your transactions costs and your annual fees and whatnot, they approach zero. And so it seems such an easy thing to do to get broad exposure to the stock market, not really have to think about it, and pay essentially zero in fees. I mean, that's an attractive prospect for a lot of people who don't consider themselves expert stock pickers. Now, to the extent that people do want to exercise some discretion in how they allocate across the stock market, look, there's an ETF for everything now. Everything you can possibly imagine has an ETF that's been designed to allow you to implement that view, to overweight a given sector, to overweight an investment style, to overweight an investment theme, to be able to get access to relatively illiquid stocks in a more liquid format. I mean, active algorithms regarding allocations and reallocations based on something such as dividend yield, or whatever it might be. I mean, the list goes on and on and on. And on the one hand, that's great. I mean, I think it's something that has probably assisted in pushing down fees in general for investors, which is other factors equal a good thing. But it actually creates another situation whereby what used to be an active style almost becomes a passive style. That is, you choose an ETF that contains within it some sort of so-called smart beta, which is in theory active, but actually ends up being implemented in a passive way. And people just put the position in their drawer and never look at it again. Now,
Right.
on the one hand, that's fine. But on the other hand, what it does mean is that a lot of that passive money just keeps going and going and going and going in the same direction, with overall less discretion being applied to it. And you could argue that longer term, that it has the possibility to maybe misallocate resources. That is, stocks that are expensive just keep on getting expensive. Stocks that are good value just keep becoming cheaper. And that, of course, has real implications for who has access to capital, who's able to invest in their operations at attractive rates. So there could be some underlying economic damage being done there, but it's very hard to see.
Right. Yeah, it's something that people wouldn't be so aware of because everyone does like automating their investing these days. And you've got a monthly payment or with pensions, it's even more automated because people don't even think about it happening. And if it just flows into some kind of passive strategy, and you imagine all of the money from all of the everyone's pension going towards a certain passive strategy, you wonder who is it that's in the market that's thinking, well, this is underpriced or overpriced, therefore I'm going to allocate this way, when the majority of people are simply buying something because it's inside a certain index. Do you think, John, when you're looking at this trend that we've seen already and going forward, And as you said, where with people using these strategies so much that things that are expensive just become more expensive, things that are good value just get cheaper. If we've seen 34 times the average over the past 25 years more cash entering the market this year, all things being equal, do you think that this might just get even more extreme next year? Do you think this is something that can just can carry on blowing out like this?
Well, look, it could. I mean, these things can run for a long time. The danger you have now is what you've pointed out already, which is that valuations are truly extreme in a historical comparison, in particular in the US. The US is a very expensive stock market on all common valuation metrics. Price earnings ratios, trailing price earnings ratios relative to GDP, relative to sales, book value, enterprise value to EBITDA,
Right.
which is one of my favorite metrics. I mean, the list goes on and on. And there are some very, very sophisticated, value-driven equity investors who have developed, very sophisticated valuation metrics, which are kind of their own customized metrics. Some of those I think are outstanding, and they are also pointing towards very excessive valuations. And what's particularly scary is on some of those metrics, the broad market in the US is just as expensive today as tech was in 1999.
Right.
That really gets me a bit worried.
That is quite a statement, isn't it? When you think of the entire, effectively the entire market being just as expensive as the dot-com darlings, which we don't hear about so much anymore. Yeah, I mean, John, do you think similarly we're at the same kind of precipice then that dot-com was back in '99?
Well, you can't dismiss that risk, and I think it's a material risk, and I think all investors should be fully aware that we're in that unusual situation where not just one hot sector of the market, but the whole broad market could be potentially exposed to an unusually sharp correction here. I think that's absolutely possible. At some point, I think it will happen. It's just that I can't time it to save my life. I mean, I think I've called about 13 of the last two corrections or something like that, right? So I don't have the world's best track record in that regard, but in retrospect, right, those two corrections were entirely necessary, and the next one that's coming will be entirely necessary too, in my opinion. So the best thing you can do is to simply structure your portfolio in a defensive way. I mean, that's what I'm doing, and that's what I recommend anyone does, given this current starting point. Structure your portfolio in a defensive way. And what's important, however, is that there are multiple ways to go about constructing a defensive portfolio. One way to do it is still to incorporate inflation hedges. That is, you get defensive, but you get defensive in a way that still protects you from what I believe is a worrying inflation outlook going forward.
Yes, it is. Well, here at Southbank Research, we do generally we do have plenty of our readers. It's a big part of our base for those watching. Do like to structure their portfolios defensively because they're we're all vigilant people here, right? We don't want to see anything bad go wrong, especially when you see the amount of risk that there are out there. Now, just in terms of what we've received ahead of time, when I did ask where do you think all of the money is coming from? We did get a couple of responses that I'd like your opinions on, John. I think it was Richard who did comment that the handouts to the masses, so the stimmy checks that you guys over in America got, whereas over here it was quite a different system with furlough, but fiat currency being handed to the masses, monies are being funneled into the market for get-rich-quick transactions. So that was from Richard. Thank you very much for that comment, Richard. Do you think, John, how much do you think the stimulus checks are actually adding to this entire dynamic?
Well, I mean, if you add them all up, I mean, that's a huge figure, right? I mean, if all of that went into the stock market, I mean, I forget exactly what it was, but I mean, that would have absolutely been quite spectacular, and certainly some of it did. I think that is a contributing factor. Keep in mind, however, that the stimulus checks were distributed very, very broadly in the U.S., whereas the vast majority of people who invest materially in the stock market tend to be the wealthy, and so. I mean, to the extent those stimulus checks did not merely get spent and did get invested, that's going to be only a portion, in my opinion, right? The ones that got saved by the masses were probably just placed in bank accounts for a rainy day, as opposed to finding their way into the stock market.
Right. There was another response here, which I think is a very interesting observation, and I'd like to know what you make of it, John, because it goes into sort of the plumbing of the financial system and how this can affect the total amount of capital flowing into the market. So Kim commented that leverage is one of the reasons why we are seeing such a vast amount of cash go into market. Now, a while back, we did have a discussion about the collapse of a hedge fund called Archegos, which was using a huge amount of leverage via swaps in order to get, just to make huge amounts of money off big tech plays. And when Archegos collapsed, this caused a big correction in a lot of these tech names. Now, I wonder, just in terms of how leverage functions and the different forms of leverage one can get, do you think leverage could be contributing to the total amount of cash that has flowed into the market?
Well, the thing about leverage, which you need to understand, is that while in theory there should be a limit, that limit is actually only imposed by the market on itself. And so if, for example, hedge funds or other investors want to go to a bank and get a line of credit to borrow in order to invest, as opposed to invest with so-called real money,
Yeah.
real capital, um, I mean, how the amount that bank is willing to lend, I mean, it's very much a function of that bank's internal risk management processes. But banks need to make money, and if they don't take risk lending out to risky hedge funds or other institutions, they're not going to make a return on their cash, and they kind of have to. And I mean, from the bank's perspective, they're financing themselves from the central bank at essentially 0%. So as long as they can get any positive return whatsoever, I mean, it goes to the bottom line. So banks are in this sort of environment, and this is kind of the intent of Fed policy in a way, central bank policy in a way. Banks are more than happy to try and push, the practical limit on the amount of leverage they can provide to investors, because at least they get to return they get something, they get some sort of return on those credit lines. And so, yes, I mean, it's up to the market itself to decide when to turn the switch off. And this, of course, is one reason why we've gone through so many boom and bust cycles in recent years, because the marginal buyer is always a leveraged buyer. I can't stress that point enough. The marginal buyer in the market, that is the one that is pushing valuations ever more extreme, that's always being done with leverage. And so, when you get your little hiccup somewhere, when a given bank decides, oh, gee, maybe we've extended a little bit too much credit to that leveraged marginal buyer, and they say, look, we're not going to give you any more, well, then the bid disappears, and everything can come crashing down, the way that within a complex system, things can all come crashing down. And so we're absolutely positively living in that sort of environment right now. I don't think anyone denies it. I think in a way, central banks acknowledge it between the lines of their rhetoric, because they're clearly concerned that in the same way marginal leverage is pushing the market to new highs and potentially exposing a sharp reversal, incremental tightening by central banks can be, the exogenous minor shock that crashes the whole party. So that is the environment that we're living in, and we do hear regularly worrying comments from some central bankers about that, in particular in the U.S.
Yeah, on that note then, John, because we do have Jackson Hole coming up, and we have heard a lot of talk, a lot of chatter about the Fed tapering. I would be interested to know your comments on whether or not the Fed can taper. In terms of the money printing the Fed has been undertaking over the past year, is there any room now for the Fed to say, actually, we're taking away the punch bowl, we're going to stop printing so much money, and we may even, I believe one of the Fed officials has actually even spoken of raising interest rates as well. This, to me, I think the Fed's kind of in a trap here, and they're not going to be able to taper. Any attempt to taper is just going to cause an event which will cause them to stop tapering. But what do you make of it, John? Do you think they can actually get away with it? Because when you're thinking of the marginal buyer leaving the market and the central bank raising interest rates being the straw that breaks the market's back, do you think that tapering might be that? Do you think that's a possibility that's on the table?
No, absolutely. And let's face it, the Fed is in a trap of its own making. I mean, they may struggle to see it that way, but I certainly see it that way, and I'm not alone. They have painted themselves into a corner. Choose your metaphor, whatever. Okay. But what that also means is that even internally, even in their private discussions between themselves, such as many of which are going to take place at Jackson Hole, it's difficult to be open and frank, even with your colleagues, about a topic that sensitive. It's like, gee, guys, we've got ourselves into this trap. What can we do? That's a very difficult conversation to have in a constructive way, because immediately, the blame game starts, and people, whatever it is, and that's just the way. That's human nature. Okay. Even more so in their external communications. My God, I mean, if they can't even agree what to say amongst themselves, are they going to be able to put out some sort of message to the rest of the world, what it is they're going to try to do and how they're going to try to accomplish that in a way that is in any way truly honest, frank, and open? No, it's not going to happen. So you have to, as trained Fed watchers or other central bank watchers are, you've kind of really got to be well trained to be able to read between the lines. No matter how good you are at that, you're still guessing, but at least it's an educated guess at that point. And I think it is interesting to point out, therefore, that there is now some clear dissent at the Fed. Multiple regional Fed presidents, which traditionally is where dissent comes from,
Hmm.
multiple regional Fed presidents have indicated very recently that they really think the taper needs to begin soon, right? Yeah, within months, if not immediately. And that does appear to go against the most recent comments by Chairman Powell, who, of course, represents the Board of Governors in Washington, D.C. So there does appear to be a bit of dissent. Now, one thing I would point out, there's been actually very little dissent at the Fed ever since 2008. There's been near unanimous agreement what has had to happen. Fed dissent used to be far more common back in the 70s, back in the 80s, back in the 90s. Fed dissent was the norm. There was always at least one or two, usually regional Fed presidents, sometimes members of the Board of Governors, who were very outspoken in their criticism. That really hasn't been the case. And what we're seeing now is again pretty minor, but placed in context of the post 2008 world, it's actually maybe a bit more significant.
Yes, it's almost like a marginal change, right? So, or as a rate of change, right, from 0 to 1. It's quite a big shift post financial crisis, especially now when we're in this very unique place economically, where we're sort of halfway between a lockdown and a reopening, and people are wondering if there's going to be more lockdowns again. Do you think, John, that I mean, what do you think the regional Fed presidents? How much of an influence do you think they've actually got? Because everyone, normally says, well, it's the chair is the guy who really has the power, and then it's the New York Fed that really need to be listening to because they're the ones most plugged into the financial markets. How much dissent can be sustained without anything changing?
Well, this is the great trick of the original Federal Reserve Act, written back in 19 well, in response to the panic of 1907. They got together and started drawing up the Federal Reserve Act, which came into force, I believe, in 1913.
Yep.
And they of course had to get a central bank approved by the U.S. Congress, something that was politically extremely difficult. There was huge opposition to a central Federal Reserve Bank in the United States, and so they had to come up with a way to get it through Congress. And so they came up with this system of regional Federal Reserve districts, and I forget exactly how many, but it's not a small number.
12,
And sorry, you
12, I think.
12. Okay, right. And they're distributed around the U.S. for the most part. Although oddly enough, there are two very very close together right in the middle of the Midwest, which is Kansas City and St. Louis.
Right.
Um, but that again, that was for political reasons. But in any event, so you've got these 12 regions, and then the number of seats on the Board of Governors, including the chairman, I believe is only 7. And so on paper it looks like, oh, the regions will at least control this thing because they have more votes. But there's actually this rotating system where only a couple regional Fed presidents are voting members at any one time, the New York Fed president always votes, even though there are regional Fed presidents. And then, of course, the Board of Governors is centralized in Washington, D.C., and therefore disproportionately subject to D.C., which is effectively New York when it comes to finance,
Right.
interests. And so, really, in practice, the FOMC is a centralized institution. The regional Fed presidents, in terms of their influence on monetary policy, is primarily symbolic. They really don't have any power at all other than to open their mouths. And so I think that was by design. I think that was very deliberate. And that's the way the Federal Reserve has operated throughout its history and certainly continues to do so today. So, yes, each regional Fed does appoint its own president. They each have their own board. Those local boards are comprised overwhelmingly of local business people, successful business people.
Yeah.
And so, yes, it's conceivable they appoint someone who disagrees very strongly with the Board of Governors in Washington, but it's really just a symbolic dissent. It doesn't carry any policy weight, in my opinion.
What do you think it symbolizes then that we are now starting to hear, well, some some dissent from the different presidents? Do you think that from those that we have heard it from, do you think that they have enough sway that they may be able to force Powell's hand?
They can't force Powell's hand, but what they can do is they can contribute to changing the discussion a little bit around the table. And look, I mean that in a healthy institution, I mean it's very helpful to have a handful of radicals,
Yeah.
if you want to call them that, who ask some difficult questions from time to time. But sadly, that hasn't been happening a lot, as I pointed out.
Yep.
And so you have had excessive groupthink for a long time now, and seeing any dissent at all is therefore, I mean, it's therefore quite refreshing. But I don't think it changes policy, but at least it changes the discussion that's taking place. Um, Maybe under other circumstances that will change policy at some point, but I don't think we're there now.
Right. As mentioned earlier, Jackson Hole is coming up, the great central banking retreat, where all the central bankers, or as many, I don't know who can all make it this year, like to stand outside drinking coffee against a very beautiful landscape over in the States. This has been used as well. A lot of bond investors love looking at this event as this is where they're going to outline their policy going forward. This is what you need to be watching if you want to know where interest rates are going to go in the future. John, what do you think Powell is? Do you think Powell's going to announce anything major? Is this something that we should be watching with a lot of intensity?
My personal view is no. I don't think he will. I think there's too much uncertainty right now. I think if anything, the pressure to start tapering, if anything, that pressure is going to begin to wane again, because you've seen a rash of relatively weak leading indicators over the past couple of months in the U.S. And that's every trickle of data changes the discussion a little bit there, and you've seen it swinging into negative territory a bit. So I think that if anything, while we're going through this period when Powell may have been subject to a fair bit of internal dissent, if anything, that may have already begun to soften a little bit. And so I really don't think he's going to make any shift, any commitment towards tapering coming
Right.
out of Jackson Hole.
Right. Like when you're talking about economic indicators are starting to signal that things are about to get bad over in the States, can you be specific? Are there any tidbits you can give to
Yeah.
our audience as to what you've been looking at?
Yes, the regional and national PMIs, that is the purchasing manufacturers indices, purchasing managers indices. Those tho- those are when it comes to truly leading indicators, because a lot of indicators that claim to be leading are really just coincident, in my opinion. But
Right.
when it comes to when it comes to truly leading indicators, those are pretty much as good as we've got. And while they're simply based on surveys, and therefore they're called soft data as opposed to hard data. I mean, after all, you're asking people their opinion,
Yeah.
but nevertheless, they have an excellent track record. They really do, and they have looked pretty poor Don't get me wrong, they were looking outstanding and very, very strong a few months back, but they have started turning down. And that to me is significant.
When you're thinking of how far ahead that they are signaling a downturn, how long do you think we've got until these opinions start being reflected in a downturn in the actual data?
Yeah, I believe that the PMIs are designed, and you can bear this out. You can see this in a historical time series analysis. I believe they're kind of designed to be useful primarily on a 3 to 6 month horizon. Something about like that. So not way into the future. There are other leading indicators that look much further out, but they're much less reliable.
Right.
And so the PMIs are kind of pointing to 3 to 6 months ahead.
I wonder if changes in COVID policy is going to cause any, like in 3 months' time, is going to cause any skew, which may then hide some of the data. It depends if we get another lockdown or not, I guess.
Well, this is the problem with economic forecasting when you get into a world where the fiscal authority is so dominant
Yeah.
and arguably somewhat capricious in how they're going about things. When you're getting a new stimulus package every year, which is driven by some new political force sending money this way one minute and that way the next. The traditional macro forecasting rules don't necessarily apply.
Yeah.
This is not when it's not a natural private sector driven economic cycle, but rather one being, kind of directed by Washington or, by the government in any country in the world. That kind of throws a wrench into the forecasting, machine. So you can still make your educated guesses, and look, good macroeconomists do have models that try to incorporate what the shifting fiscal orientation of policy is, but the more it shifts, the harder that becomes.
Yeah, the closer we get to the Soviet Union, the harder it comes to project for these things.
Yes, indeed.
But John, just in terms of our last video we did when we were looking at, I think it was last time we were on the petrodollar, and what changes we might see in the future on the fate of the petrodollar. We did get a few comments there with some people asking for future topics. There was one on the role of central bank digital currencies. The acronym CBDC has been thrown around for many years now. We at Southbank have covered the future of CBDCs and what they might mean for investors in a lot of detail in the past. But John, what's your take on that? Because we have been talking about central banks. Jackson Hole, is where they all like to get together and chat about stuff. I believe Mark Carney was pretty big on going for digital currency or some medium of digital settlement before he left the Bank of England. I don't think we've heard quite so much from Bailey, now the new Bank of England governor. But in your view, do you think we're going to see central bank digital currencies, and if so, in what kind of form?
Oh, absolutely. I think we're clearly on that road. I think it's much more a question of implementation and execution than it is whether or not it will happen. I think it will happen. That said, it raises all sorts of problems because physical cash plays an absolutely essential role in certain sectors of the economy, in particular, people at the lower economic rungs who really depend on odd jobbing and local economy type work in order to get by. And that is nothing to scoff at. These if you make a living hand to mouth, but at least you're making a living, that living is absolutely positively dependent on physical cash changing hands.
Big time.
And you can't just pull the rug out from under those people. It is irresponsible. And so what I think will happen is you're going to move to a digital currency that is a parallel currency with physical cash which still exists. And then the physical cash will slowly and very, very gradually over what I believe will be a long period of time will be phased out in some way. At least that's what they're going to try to do. And they're going to try to incrementally reach into those marginalized groups and try to get them somehow access through prepaid cards or some other electronic something, the phone payment systems, who knows what it might be.
Yeah.
They'll try to get those people on board and wean them off physical currency, but they won't do it all at once because it's impossible and disruptive to
Yes.
do that. But we're definitely going down this road, in my opinion.
Yeah, it's quite worrying when you think of it that way. India has had its own experiments with phasing out cash, and with the abruptness with which it was done, people died in some of the trying to get to banks and things like that. Very. It does seem like we're definitely going down that road. I think it's just how abrupt it is. Here in the UK, it's all we've got a very big nudging state where things aren't made mandatory immediately. They'll just try and get you, like, we're probably, in my opinion, we're probably not going to get mandatory vaccines here. They're just going to try and shut off all the things that you can do in order to get people to get them. And you can really imagine something like that happening with cash as well, where you can try paying with cash, but a lot of businesses that have just started existing now in this COVID age have only been using cards. So if you present them with cash, it's almost like you're presenting a relic from a bygone era. So it's like traveler's checks in some way. I mean, they still exist, but whether or not you could you're really going to be able to get by with them is another question entirely. John, are there any other before we tie up for this week? Are there any other topics that you'd like to discuss on Southbank Live?
Well, really, I would just like to offer a constructive follow-up to what we discussed earlier when we talked about the stock markets. I mean, again, the stock markets are looking expensive in valuation terms, but really, that's really concentrated in the United States.
Big time.
There are good reasons for that. Okay, the U.S. has been an expensive market in valuation terms vis-a-vis the rest of the world on average for a long time. And one reason why is because for global investors, the US forms part of their benchmark. You can't not own it, right? You have some benchmark allocation to it. But that's not true of the UK, for example. There's not the same sort of requirement to have an allocation to the FTSE. And so there are these inherent biases in the market. But if you're a value investor, and you don't have jurisdictional constraints regarding where you must or must not invest. I mean, the UK is much more attractive, in my opinion. Now, you have to adjust it for the fact that the UK, the distribution in the FTSE is very different than in the US. The US is extremely tech heavy. The FTSE isn't tech heavy at all. The UK is heavier financials. The US, of course, has financials, but they're not particularly heavy. And so you have to look at sort of sector by sector comparisons here. But if you simply take the broad market, the UK looks cheap. Keep in mind also what we said about dividend yields earlier. The S&P 500 currently yields about 1.3% at current prices and dividend rates. The FTSE is at 3.4. That's a big gap, especially in a world of low interest rates when every incremental percentage point matters. So again, don't get me wrong, if you're going to be investing in UK stocks, I would still suggest a very defensive posture. But if the choice is, do I overweight the UK or the US here, I would definitely be overweight the UK relative to the US, but with a defensive stance.
Right. Of course, we don't give investment advice here on Southbank Live, but it is great to hear such a glowing vote of confidence from an American, John. I'm sure
Relative confidence.
Relative confidence, quite. I do think it's interesting. You say we're very heavy financials in the UK, and of course, commodities. You get so many of the big commodity giants have their headquarters here, and they're listed on the FTSE. And when we're talking about inflation, I think it will be very much in the UK's favour that they've got such a density of commodity extractors of various kinds listed in the FTSE. It'll be interesting to see how that works out vis-a-vis the US when commodity giants aren't normally so headquartered over there. Probably pretty good for Canadians as well, right, John? Because so many of the commodity companies are listed out there.
Yes, absolutely, absolutely. And again, if you're looking for a defensive posture that helps to protect you from inflation, you can be overweight the basic industries, the commodity industries, and underweight financials. That's one simple step in that direction.
Yeah, that's an interesting sort of pairs trade, isn't it? It will be interesting to see how things develop where vis-a-vis inflation over the coming months, and we shall keep up with it here at Southbank Live. But if you are watching this, we shall be off for today. It's 10:44, so it's almost 10:45 now. John, thank you so much for joining me.
My pleasure as always, Buzz.
That's all from us for today at Southbank Live. I hope you enjoyed it. If you did, do feel free to leave any feedback below, and do subscribe to our YouTube channel if you haven't already. We shall be back next week. I'll be bringing on a different guest, as John will be taking a break, but who is going to be coming on has yet to be ascertained. So got that to look forward to. In the meantime, I hope you have a very good weekend. Goodbye.
Goodbye.